Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Great to be here.
We're here to help you dive deep into a fascinating collection of recent reports. We're looking at CNBC, Reuters, MarketWatch, quite a mix.
Yeah, lots together.
Our goal today, really, it's to cut through the complexity, give you the essential insights, maybe some surprising facts from global markets, geopolitics, tech. Get ready for a concise, but we hope comprehensive, look at what's truly moving the needle in your financial world.
Let's jump in.
Okay, let's start by taking a pulse on the global market picture. Looking at reports this morning, June 19th, Asia-Pacific markets, seeing some notable declines.
Yeah, definitely seeing some red over there. Hong Kong's Hang Seng, that one really stood out, down over 2%.
Right. And mainland China's CSI 300, down almost 1%, 0.82%.
That's right. And Japan's Nikkei 225 also lost just over 1%.
Yeah.
So broadly down in Asia.
But what truly stands out here, I think, is how these regional moves connect to the bigger picture, right? Creates a ripple effect.
Exactly.
Yeah.
While Asia saw declines, if you look at Wall Street overnight, it was a bit more mixed. The Dow was down slightly, maybe 0.1%.
S&P 500 dipped just a tiny bit, too.
Yeah, almost flat. But the NASDAQ actually managed a small gain. Just goes to show different indices, different stories sometimes.
We also saw some interesting currency shifts.
We did. The Vietnamese dong, for example, weakened to a record low against the dollar. That really reflects a broader strengthening of the U.S. dollar we've been seeing.
Affecting other currencies in the region, too, like the Thai baht.
Yeah, Thai baht, Indonesian rupiah, seen similar pressures. It's a key theme right now, dollar strength.
Okay, and this immediately brings us to another critical factor impacting markets right now, the escalating conflict between Israel and Iran. A major focus.
Recent reports, Bloomberg had one, suggesting senior U.S. officials are actively preparing for the possibility of a U.S. strike on Iran. Soon, possibly.
Although President Trump, according to CNBC and MarketWatch, has publicly said he hasn't made that final call yet. Right. Still officially undecided. But the preparations themselves send a signal.
They absolutely do. And that leads us straight to the question, what are the concrete economic implications of these tensions? We're already seeing it in oil futures.
They're up.
They are. Analysts like over at Goldman Sachs, they're now talking about a geopolitical risk premium of around $8 to $10 a barrel for Brent crude.
Can you just quickly unpack what that premium means for listeners?
Sure, it's basically extra cost, right?
Okay.
Added onto the price simply because of the increased uncertainty, the fear of supply disruptions due to all this political instability.
Got it. And the biggest concern for oil supply, everyone keeps pointing to the Strait of Hormuz. Shell even warned about it.
It's the crucial choke point. About a fifth, maybe 20% of the world's crude passes right through there.
So any disruption, even a temporary one,
could have a profound, immediate impact.
Yeah.
Global energy prices, supply chains.
Yeah.
It would send shockwaves far beyond the Middle East.
And it's not just crude oil feeling the heat. Shipping insurance costs. I saw reports from CNBC, Marsh McLennan, they've surged.
Dramatically. Marine insurers are now charging, what, 0.2% of a ship's value for journeys into the Gulf?
Yeah, up from 0.125%. That's a big jump.
Huge. And cover for Israeli ports. More than tripled. Up to 0.7%.
And the quotes are only valid for 24 hours now, down from 48?
Yeah. That tells you how fast things are moving, how quickly the risk assessment is changing. It reflects a rapidly deteriorating security situation, frankly.
So, zooming out, how does this fit into the broader risk picture? JP Morgan did some analysis.
Right. They said, look, the current jump in oil prices might not cause a long-term shock by itself, but
What?
the big what if is regime change in Iran. If U.S. or Israeli military action led to that, that could have a profound impact on the global oil market. That's the much bigger, more disruptive scenario analysts are watching.
On the diplomatic front, though, Israeli President Isaac Herzog told CNBC something interesting. He said regime change isn't the official objective.
What did he say the goal was?
To remove the Iranian nuclear program. He accused Tehran of rushing to the bomb and said sometimes tough action is needed to remove threats.
Okay. But it's crucial to see the different international viewpoints here. The G7 summit reports from CNBC and MarketWatch showed this clearly.
The G7 countries are largely aligned, supporting Israel, condemning Iran.
Generally, yes, stating Iran shouldn't get nuclear weapons. But then you have China.
A different stance.
Completely. China explicitly condemned what it called Israel's violation of Iran's sovereignty, and they publicly support Iran's right to safeguard itself.
So, a really complex geopolitical chessboard. Very different perspectives from major powers. Makes any easy resolution seem unlikely.
Incredibly difficult, yeah.
Okay, these global flashpoints, especially the oil price impact, they inevitably put pressure on central banks. Let's shift focus. How is the Federal Reserve navigating this? What do their latest decisions mean for you?
Right. Well, as pretty much everyone expected, and it was widely reported, the Fed held interest rates steady on Wednesday.
Keeping that benchmark rate in the same range, 4.25% to 4.5%, where it's been since December.
Exactly. No surprise there. But what is really interesting is their updated economic outlook. You see it in their dot plot.
Can you remind listeners what the dot plot is quickly?
Sure. It's basically a chart. Each Fed official puts a dot showing where they personally think interest rates will be in the future, anonymously. It gives us a visual sense of the committee's collective thinking.
And what's their latest plot showing? Still rate cuts this year.
Intriguing picture. Yes, they still point to 2 rate cuts later this year. But, and this is key, they've actually lowered their GDP outlook for 2025, down to 1.4% from 1.7% back in March.
Lower growth and inflation.
They raised their inflation forecast. The PCE price index, that's the Fed's preferred measure, it's broader than just consumer prices.
Right, captures more spending habits.
Exactly. They expect that to rise beyond 3% this year. That's up from their 2.8% forecast in March.
So let's connect the dots for people. Higher inflation forecasts, lower growth predictions. What does that practically mean?
Well, it signals what a lot of commentators are now calling early signs of stagflation.
Stagflation. That sounds not good.
It's not ideal. It's a challenging environment. Traditional investment wisdom might need rethinking. Hard assets like commodities or real estate might behave differently than growth stocks. Bonds get trickier. It really forces you to rethink portfolio diversification.
Fed Chair Powell himself seemed to acknowledge this direction. He mentioned tariffs.
He did. In his press conference, covered by CNBC, he said growth will slow eventually, and he directly linked rising inflation expectations to tariffs. He basically said, everyone is forecasting a meaningful increase in inflation from the tariffs because someone has to pay.
And ultimately, some of that falls on us, the consumers.
Yeah. That's usually how it works, yeah.
Now, that brings up the political pressure, doesn't it? President Trump has been very vocal about the Fed.
Extremely vocal. CNBC reported him insisting the Fed funds rate should be at least 2 percentage points lower. He even publicly called Powell stupid.
Strong words. What's driving his concern there?
It seems to stem directly from the cost of financing the U.S. debt. It's huge, $36 trillion. And the interest payments alone are projected to hit $1.2 trillion this year.
Wow. More than most budget items.
Yeah, only Social Security and Medicare are bigger. So that high interest rate really bites into the budget. Immense pressure on the Fed from multiple sides.
But despite all these worries, some recent U.S. economic data looked okay. Surprisingly upbeat, even.
It did. May saw 139,000 jobs added. Unemployment held steady at 4.2%. And that University of Michigan Consumer Sentiment Survey, more optimistic.
So a bit of a mixed signal there, too.
Very much so. But Powell did caution, remember, that it takes time for tariffs to really filter through the economy.
Right. But stuff on shelves now might have been imported months ago, before the latest tariffs hit.
Exactly. So we're maybe just starting to see those effects. And the Fed clearly expects more impact in the coming months.
Okay, so from that macro picture, let's zoom into how these currents are shaping specific investment areas. Global IPO activity, for example. Reuters data suggests it's slumped.
Yeah, notably slumped. Down 9.3% year-on-year, hit $44.3 billion, which is apparently a 9-year low.
Why the slump? Same reasons. Tariffs, volatility, higher rates.
Pretty much. U.S. IPO volumes down 12%. Europe saw a really sharp drop, 64%. One analyst, I think, from Athena Capital basically said it's just not smart for companies to go public right now. Called it unprecedented market volatility.
But here's where it gets compelling. The regional divergence. While globally it's slow.
Asia-Pacific IPO volumes have actually risen quite significantly, up 28% to $16.8 billion.
Wow. What's driving that?
Seems to be a mix of things. Regulatory easing, better sentiment in China and Japan specifically.
Any standout examples?
Yeah, the Reuters report mentioned the Chinese battery giant, CATL. They raised $4.6 billion. That was the world's largest IPO this year.
So different regional policies, different market dynamics, creating really distinct investment landscapes.
Absolutely. And it seems some institutional investors are noticing. Bank of America noted they're getting more enthusiastic about emerging markets.
And firms like Aberdeen Investments are actually favoring China and Europe equities.
Yeah, citing their strong policy tools, meaning governments there have more levers to pull to stimulate growth if needed.
Okay, now for something I found really revealing, Platinum prices. MarketWatch reported they far outpaced gold this year. That seems surprising.
It is quite surprising. Platinum's up a staggering 44% year to date. Hit its highest price since, September 2014, over $1,300 an ounce.
Compared to gold's 29% climb? Still good, but platinum's way ahead.
Way ahead. The key takeaway here seems to be this idea of gold fatigue.
Gold fatigue.
Yeah, analysts like Vaibhav Agarwal from Index suggest investors are actively rotating, moving out of gold, moving into platinum.
Where are we seeing this play out?
Particularly in China, interestingly. Jewelers there are apparently switching from gold to platinum more often. Why? It's cheaper, relatively, and consumer tastes might be shifting.
And jewelry buying in China is often partly investment, right?
Exactly. Plus, bar and coin investment demand for platinum in China is also running hotter than expected. It looks like a broader shift in how investors there are thinking about precious metals.
So given all that, is this a real structural shift for platinum? There seems to be a debate about supply.
There is. The World Platinum Investment Council, the WPIC, they forecast a material platinum market deficit for years, right through 2029.
Saying above-ground stocks are unsustainably low, like only 3 months' worth of demand.
That's their take. But then you have CPM Group, another respected commodities research firm.
They disagree.
They do. They actually forecast a platinum surplus for both this year and next year.
A surplus? How can they be so different?
Their managing director, Jeffrey Christian, suggests there are enormous amounts of platinum stocked up around the world. He argues the market isn't truly in deficit, especially if you don't count investment demand in their main calculation. They focus more on fabrication or industrial demand.
So it comes down to methodology, how they count supply and demand?
Exactly. It really highlights how crucial it is for you as an investor or just someone trying to understand this to know how different researchers arrive at their conclusions. One includes investment flows, another doesn't. Leads to totally different outlooks.
That's a really important point. Okay, shifting gears completely now, from traditional markets to tech. A huge story out of China, highlighted by CNBC, AI human influencers.
Oh yeah, this is wild. A Chinese entrepreneur, Luo Yonghao.
Right, he used these interactive digital avatars, powered by Baidu's AI, for live streaming his products.
He did. And the result was staggering. He pulled in $7.65 million in just 7 hours.
7 million from an AI avatar, more than his personal streams.
Far more. He even said himself, the digital human effect scared me. I'm a bit dazed. You can see why.
One analyst called it a DeepSeek moment for China's live streaming industry.
Yeah, suggesting it's a pivotal point.
Yeah.
And you can see the advantages, right? These AI avatars, they slash costs. No big production teams, no studios needed.
And they can stream constantly, 24/7, no breaks.
Exactly. The scalability, the reach. It's huge. This isn't just about efficiency. It could fundamentally change how brands connect with customers. Think about celebrity endorsements, customer service, maybe globally, not just in China.
It feels like a preview of AI moving from the back end to the front line.
It really does. Raises profound questions about the future of work, intellectual property, and content creation. Lots to unpack there.
So what does this mean practically for the AI industry itself? Other companies are jumping in.
For sure. Tencent's developing similar tools. But there are challenges. Compliance, platform rules.
Right. CNBC mentioned Douyin has restrictions. Virtual people have to interact genuinely.
Yeah, so it seems the tech itself might not be the biggest hurdle now. It's more about navigating the rules, the regulations, the platform requirements around authenticity and engagement. That's the tricky part.
And speaking of the AI industry evolving, there's ongoing consolidation too, right? That Meta and Scale AI deal.
A huge deal, yeah. Meta investing $14.3 billion for a 49% stake in Scale AI. Scale's founder even moved over to Meta.
But that caused some ripples. Scale's other big clients, like OpenAI and Google,
reportedly started winding down their work with Scale AI, according to CNBC. They seem to be looking for partners who've kept pace with innovation.
OpenAI specifically said it wasn't just the Meta deal, but about needing faster innovation.
That was their stated reason, yeah.
Yeah.
It just shows how dynamic and competitive this space is. Strategic alliances can shift the ground really quickly, even for big players.
Okay, so beyond the Middle East, beyond tech shifts, trade relations are still very much a hot topic, directly impacting global economics.
And always simmering, yeah.
According to CNBC, we're getting close to that July 9th deadline. The possible return of the Trump administration's reciprocal tariffs. Some could face a 50% duty.
That's the looming deadline, yeah, if no new deal is struck.
So the big question, will they actually come back? What are analysts thinking?
Well, Goldman Sachs' chief economist, Jan Hatzius, he doesn't think so. He predicts the pause will just get pushed out again. More negotiations. MarketWatch echoed that sentiment.
But even without those specific tariffs returning, the overall U.S. tariff rate has gone up this year.
It has, by about 10 percentage points already. And they expect another 4 to 5 points from new sectoral tariffs, things like semiconductors, pharma products.
So think of it like an extra toll fee at the border for certain goods coming in.
Pretty much. And eventually that cost tends to get passed on.
To us, the end consumer, makes imports pricier.
Right. And beyond that, it signals that deeper shift in global supply chains. Companies thinking more about reshoring, diversifying production to avoid these tariff risks.
Okay, finally, here's a diplomatic moment I found fascinating and pretty direct. Reported by CNBC, Indian Prime Minister Modi contradicting President Trump.
About mediating between India and Pakistan.
Exactly. Trump claimed he helped broker a ceasefire earlier this year, but Modi, according to India's Foreign Secretary Vikram Misri, firmly stated that India does not and will never accept mediation on that issue.
Wow. What I find really striking there is that the phone call, apparently a 35-minute one, was initiated by Trump.
So Trump called, and Modi basically said, you had nothing to do with this de-escalation.
That seems to be the message conveyed, yeah. And also that there was no discussion of a trade deal, even though Trump had mentioned that publicly too.
Trump even compared it to the Israel-Iran situation, saying he got India and Pakistan to make a deal.
He did make that comparison publicly, which India then flatly denied. It's quite rare to see such a direct public contradiction between heads of state like that.
Really highlights the complexities, doesn't it? And the different narratives that play out on the global stage.
Absolutely. How leaders sometimes craft stories for their home audiences that might not fully match the diplomatic reality. Affects trust, relationships.
So as we wrap up this deep dive, maybe something for you, the listener, to consider, how do all these seemingly separate threads, you know, the rise of AI influencers, the volatile markets driven by geopolitics, the shifts in trade policy, these unexpected commodity surges like platinum, how do they all weave together?
How do they coalesce to define the economic reality we're actually living in right now?
Exactly. And what does this really complex, interconnected web mean for your own understanding of the future? Maybe for your investments, your career path. The insights from these headlines are, we think, pretty crucial for navigating it all.
A lot to think about.
Definitely. We'll see you all tomorrow morning with new headlines from major financial magazines.